All right. Hello, guys. Today we will talk about a surprising announcement by the Reserve Bank of New Zealand, or maybe not so surprising actually. And the title for today's video is about no deposit for house. Right? So today we'll talk about where is the Reserve Bank taking us, the Reserve Bank of New Zealand. Having said that, I think a lot of other reserve banks globally are doing similar sort of, say, quantitative easing, reducing interest. But one of the main ones right now that's happening is they are reducing the loan to value ratio required needed for a mortgage, right? So let's figure out what this is all about. Right? So I got 4 people watching. Wow, look at that. Okay, so I think earlier, like later last week, the Reserve Bank announced that from 1st of May, it will remove the loan to value ratio for 12 months, right? So given that Reserve Bank are the ones who decide the kind of the interest rates for the central reserve rate, they're the ones who have the power to do large asset purchasing kind of thing to like buy government bonds, reduce interest rates. They're the ones who can kind of limit the bank from loaning money if with a ratio and all that. Like I think about 4 years ago, 2006 or 2007-ish, the Reserve Bank mandated that all the loans given out by banks need to have a 20% like loan to value ratio. So the key bit here, right? It's a mortgage kind of loan to value ratio. That's it's kind of the keyword here, right? So what the mortgage loan to value ratio is if you want to go and buy a house, the loan to value ratio is a percentage deposit you're putting down towards your house here, right? So having a low loan to value ratio means you're borrowing a bigger proportion of your money, right? But having a having a zero loan to value ratio kind of just means you're putting down no deposit, right, for buying a home. The key reasons why the Reserve Bank made this decision was they're fearful of, say, the COVID-19 pandemic, where it would cause some financial instability. So they're thinking this would make the financial system more stable, right? Keep the house price where they're at. Hopefully it doesn't fluctuate too much up and down, and then hopefully things will smooth out, and a few months later everything will go back to normal, right? So that's what they're hoping. So just make sure I'm not pulling this out of thin air. This is indeed a kind of an announcement by the Reserve Bank of New Zealand later last week, actually. So this is an actual official announcement. And what is kind of strange about this is they only given out about 1 to 2 weeks for people making submissions, right? Like to hear the feedback. So this is typically quite unheard of. So normally when Reserve Bank kind of want to make a change, like a big change towards a policy, they will have quite extensive period of feedback. But in this case, they have reduced the period for consultation, which is understandable. They have to make a decision quickly given how quick the COVID-19 situation is happening. But even in that very short period, they have received quite a number of submissions about this, right? And from those submissions, we see people who really support this. We see people who are really against it. And we also want to talk about who are the winners and who could be potentially the losers from this removal of loan to value ratio restrictions, right, from the Reserve Bank. So to figure out who's the winners and who are some of the potential losers, it's like have a look who is supporting it, right? Like who the ones who is going to benefit are the ones who are going to support the most, right? So who are the ones supporting it? So we found 3 links. I think they're quite illustrative of the people who gave feedback, and there was another group of people who kind of didn't give any feedback. We're going to talk about them as well. So the 4 group of people are the advisors, right? The financial advisors, the bankers, right? So they're group number 1, right? The group number 2 are the homeowners, right? The ones who own the homes, the ones who borrowed money to buy a home, or who are like landlords or homeowners, right? Owner-occupiers. We get criticism as well, like by some so the third group would be things like people who care about sustainability, and the fourth group are first home buyers or haven't bought a home yet, right? So I'll group it down to those 4 groups. Okay, so let's start with bankers and advisors. Why are they the big winner? So one of the biggest risks now with kind of the housing kind of market is there might be a drop in the house price, right? Like some people are finding the income a little bit unstable, or people a little bit unconscious what the future might hold for them. So this naturally means they would cut back on their spending, both everyday spending and also when they also for their major kind of house decisions buying, right? They might just hold it. They might wait and see for 3 months or so, right? So why the bankers are so happy about this is by removing the loan to value ratio, now all of a sudden a bigger group of people are qualified for a loan to buy a home, right? Or people who want to refinance to buy a bigger home or buy another home, all of a sudden, like someone who might previously who be not qualified but only have about 10% deposit or 15% deposit, and where they have to require like 20% if they're like home occupier, or 35% if they're like investors, now all of a sudden they are qualified, right? So that's why for like bankers and advisors, those group of people, they look at the words they use, right? They say some advisor claim this will help banks' risk appetite, right? Basically, we just mean the banks are more willing to or able to loan out to money who just like doesn't have that full set of deposit previously, right? So having said that, there's some kind of validity in what it's saying, right? In the sense that they were saying they want to let the bank to manage the risk, right? They want to let the bank make the decision, right? So effectively, but having said that, there's a big kind of loss for like normal home buyers is this, right? The difference between owner-occupied and non-owner-occupied buyers will be essentially lost, right? So initially we had a kind of a higher loan-to-value ratio for investors, so made it the first home buyer, the owner-occupier, a little bit easier to get into the market, right? More people own their own homes. But with this, the kind of a bit of advantage that was given will be gone, right? That's where it is, right? So it shifts the decision making from the Reserve Bank of New Zealand to individual banks, right? And how are the realtor owners are thinking, right? How are the ones who have already bought a home, right? Like the ones who bought a home obviously don't want to see their home value decrease, especially the ones who bought more than one home, right? If they bought 3 or 4 or 5 homes, a small percentage of decrease in their house price would have a huge impact in their overall like net worth, right? Like especially if they borrowed to buy those homes, right? So if they borrowed 80% to buy their homes, for all their homes, say for all their if they borrow like say 75% for all their 5 homes, and where they only have a 25% deposit on average, if the house price decreased by say 5%, they will lose 20% of their overall kind of net worth in that portfolio, right? So for homeowners, for realtor owners, this is a win, right? Because for them, chances are the house price is not going to decrease or going to be not fluctuate too much because of this. And it might even boost like the real estate industry, right? It just be more people willing to kind of may not be willing, but more able to buy now, right? Especially like which market, right? Like the market that kind of mostly be saying would be like in Auckland, right? In Auckland, we all know house prices are already quite high. Like median house price is about $950,000 or $1 million, kind of a property for the median price. So kind of remove this loan to value ratio would enable some, especially like first home buyers to get in, right? So, and this is kind of like even worse. Is this would actually likely to even push up the price rather than making it accessible for everyone. So this will, they say, create like a 2-tier, right? Kind of market, right? Okay, so let's talk about the third group of people who like advocates for like sustainability for housing, right? Like especially like from like Shift Aotearoa and different organizations. How do they view this, right? Their view about this is they think removing loan to value ratio restrictions, right, where banks don't have to have a certain deposit to loan people money, tends to put profit ahead of family well-being, right? Why do they say that? Well, there have been clear records where having a lower kind of deposit rates requirements push up the prices, right? And this means more people are competing for a house, more people are competing for a mortgage, so banks are in the driver's seats, right? If a bank are offering people say a 5% deposit house and charge ridiculous interest rates, right? So right now the normal kind of mortgage rates are somewhere around 3 in New Zealand, around 3 to 3.5%, right? If they can offer people like a 5% deposit, but they give like a much higher interest rate, right? Like they might offer like a 6% interest rate or 7% interest rate, right? And that's the unfortunate fact is there will be a lot of kind of unaware borrowers, right? First home buyers, where for them it's like if they're not so into kind of economics or numbers and so on, they might not know the ins and outs of the difference, right, between a 3.5% interest rate and a 5% interest rate, right? As well as say an economist or someone who is like a banker or like an advisor, right? So that kind of puts like those vulnerable people in even disadvantaged situation, because banks, right, at the end of the day, they have to make money one way or another, right? So that could be loaning money to say people who are with very like huge amount of deposit and good ability to pay them back. They can, because those borrowers are less risky, they can offer them good interest rates. But for the more higher risk borrowers, the ones with lower kind of deposits, because you already seen that, right? If you have less than 20% deposit, somewhere between 10 to 20% deposit, you have to pay like half to 1% more on your interest rates, right? Imagine the interest rate we charge if you only have 5% deposit, right? Like, like my estimates might be, when I had a quick look over the internet, it's like if you had a 20% deposit and decent income, you can get a mortgage rate somewhere between 3 and 3.5%, right? But if you're borrowing with only a say 10 or 15% kind of deposit, you have to pay half to 1% more than the ones with the 20% deposit. So if you only have 5% deposit, chances are you'll be very likely to pay 1.5 or 2% more for taking the mortgage, right? So this is kind of situation where we really need to kind of protect the small borrowers, right? The first home buyers, right? Where the ones who's not so well known what to do.